The Federal Open Market Committee concluded its June 2024 meeting with a widely anticipated decision, keeping interest rates unchanged at 5.5%. This marks the first time since early 2022 that the Fed has opted to hold rates steady, signaling a potential turning point in its aggressive campaign to combat inflation. Jerome Powell, the chair of the Federal Reserve, delivered a closely watched speech following the announcement, providing insights into the Fed's current thinking and its outlook for the U.S. economy. Powell's tone was measured, acknowledging the progress made in taming inflation while emphasizing that the battle is far from over. He reiterated the Fed's commitment to bringing inflation down to its 2% target, indicating that further rate hikes may be necessary if price pressures do not subside as expected. The decision to pause, he explained, was driven by the need to assess the cumulative impact of the previous rate increases on the economy. Since March 2022, the central bank has raised interest rates at the fastest pace in decades, pushing up borrowing costs for businesses and consumers alike. These moves were aimed at cooling down the economy and curbing demand-driven inflation, which had surged to multi-decade highs in the wake of the COVID-19 pandemic. While the Fed's aggressive actions have shown some signs of success, inflation remains stubbornly above the central bank's comfort level. The latest data indicates that while price pressures have eased from their peak, they are still running hotter than the Fed's 2% target. This suggests that the Fed is not out of the woods yet, and that the path to price stability remains uncertain. Powell devoted a significant portion of his speech to dissecting the latest inflation data, highlighting both the progress made and the challenges that lie ahead. He noted that headline inflation has shown signs of moderation in recent months, largely due to easing supply chain bottlenecks and a decline in energy prices. However, Powell cautioned that core inflation, which excludes volatile food and energy prices, remains stubbornly high. This measure, closely watched by the Fed as a gauge of underlying price pressures, indicates that inflation is becoming increasingly broad-based. The persistence of core inflation suggests that the Fed's battle against inflation is far from over. While the initial phase of rapid rate hikes may be behind us, the central bank is likely to proceed cautiously, relying on incoming economic data to guide its future policy decisions. The Fed's preferred measure of inflation, the Personal Consumption Expenditures Price Index, remains well above the central bank's 2% target. In May 2024, the PCE index rose 3.9% from the previous year, indicating that inflationary pressures are still present in the economy. Powell's speech underscored the delicate balancing act facing the Fed taming inflation without tipping the economy into a recession. The aggressive rate hikes implemented over the past year have undoubtedly slowed economic growth, raising concerns about a potential downturn. The Fed chair acknowledged these concerns, stating that the central bank is acutely aware of the potential risks to economic growth. He emphasized that the Fed's goal is to achieve a soft landing, bringing inflation down to target without causing a significant economic contraction. However, Powell also made it clear that the Fed is willing to accept some economic pain to achieve its inflation objective. This hawkish stance suggests that the Fed is prepared to err on the side of caution, prioritizing its fight against inflation over concerns about economic growth. One of the key uncertainties facing the Fed is the state of the labor market. Despite the aggressive rate hikes and slowing economic growth, the job market has remained remarkably resilient, with unemployment hovering near historic lows. Powell acknowledged the strength of the labor market, noting that it continues to be a source of support for the economy. However, he also expressed concern about the potential for a wage price spiral, where rising wages contribute to higher inflation. So far, wage growth has remained relatively contained, but the tight labor market poses a risk that upward pressure on wages could intensify, fueling inflationary pressures. The Fed is hoping to see some softening in the labor market, such as a modest increase in the unemployment rate, as a sign that its policies are having their intended effect of cooling demand. While the Fed opted to keep interest rates unchanged in June, Powell's speech provided some clues about the central bank's thinking on future rate adjustments. Market participants were closely parsing his words for any hints about the timing and magnitude of potential rate cuts later this year or next. Powell emphasized that the decision to pause was not a decision about stopping, but rather a continuation of the process of assessing the impact of previous rate hikes. He stressed that the Fed remains data-dependent and will adjust its stance as needed to achieve its inflation objective. However, Powell also acknowledged that the full impact of the Fed's aggressive rate hikes is yet to be felt by the economy. These comments suggest that the Fed is likely to remain on hold for at least the next few meetings, allowing time to assess the impact of its previous actions. If inflation continues to moderate as expected and economic growth slows, the Fed could begin to consider rate cuts later this year or in early 2025. The stock market reacted positively to the Fed's decision to pause rate hikes, with major indices rallying on the news. Investors interpreted the move as a sign that the central bank is nearing the end of its tightening cycle, paving the way for a potential pivot to rate cuts later this year. However, the reaction on Main Street was more subdued. While businesses and consumers welcomed the respite from rising borrowing costs, many remain cautious about the economic outlook. Inflation continues to erode purchasing power, and the specter of a recession still looms large. The divergence between Wall Street and Main Street reflects the uncertainty surrounding the economic outlook. The coming months will be crucial in determining which narrative ultimately prevails. The Federal Reserve's decision to pause rate hikes comes as other major central banks around the world are also grappling with high inflation. The European Central Bank, the Bank of England, and the Bank of Canada have all raised interest rates aggressively in recent months in an effort to tame price pressures. The global nature of the current inflationary episode reflects a confluence of factors, including supply chain disruptions, surging energy prices, and strong consumer demand. Central banks around the world are facing the same challenge: how to bring inflation under control without causing a deep recession. The Fed's decision to pause could influence the policy calculus of other central banks. If the Fed's approach proves successful in taming inflation without triggering a recession, other central banks may be emboldened to follow suit. However, the global economic outlook remains highly uncertain. Central banks around the world will need to navigate these challenges carefully in the months ahead. The Fed's decision to pause rate hikes marks a pivotal moment in the fight against inflation. The coming months will be crucial in determining whether the central bank can achieve a soft landing or whether the economy is headed for a recession. Several key economic indicators will be closely watched in the coming months, including inflation. The Fed will be looking for continued moderation in both headline and core inflation. Any signs that inflation is re-accelerating or becoming more entrenched could prompt the central bank to resume rate hikes. Economic growth. The Fed will be monitoring economic growth for signs of a slowdown. A sharp contraction in economic activity would raise concerns about a recession. The labor market. The Fed will be watching the labor market for signs of softening. A modest increase in the unemployment rate would be seen as a sign that the central bank's policies are having their intended effect of cooling demand. The Fed's next policy meeting is scheduled for late July 2024. The global economy is navigating a period of heightened uncertainty. The COVID-19 pandemic, the war in Ukraine, and other geopolitical tensions have created a complex and volatile environment for businesses and investors alike. In this environment, it is more important than ever for individuals and businesses to be prepared for volatility. This includes building up emergency savings. Having a cushion of savings can help individuals and businesses weather unexpected economic shocks. Diversifying investments. Spreading investments across different asset classes can help mitigate risk. The road ahead is likely to be bumpy, but by taking steps to prepare for volatility, individuals and businesses can position themselves to navigate the challenges and capitalize on the opportunities that lie ahead. The Federal Reserve's decision to pause rate hikes reflects the delicate balancing act facing central banks around the world: how to tame inflation without causing a deep recession. The central bank's path forward will depend on the trajectory of inflation, economic growth, and the labor market in the coming months. The Fed's June meeting marked a potential turning point in the fight against inflation. However, it is too early to declare victory. The Fed will need to remain vigilant in its efforts to bring inflation back down to its 2% target while ensuring a soft landing for the economy.